exited Apple when it was $1 trillion because you were scared of just how big it was, you left $2 trillion on the table. And I would say the same is true about Nvidia. The price momentum is scary, and maybe you've missed it in the short run, but this is an important company that's going to be with us for some time.
Hello, I'm Michelle Makori. Thank you for joining us. The S&P 500 recently hit another record high propped up by Nvidia. The AI chip leader's latest earnings report showed revenue surging to $22 billion for the last quarter, up 265% year over year. Now, since January of 2023, Nvidia's share price has surged by almost 450%. With the total value of its shares approaching $2 trillion, Nvidia is now America's third most valuable firm, behind Microsoft and Apple. It also has greater value than the economies of countries like South Korea and Australia based on their GDP. Now, the blockbuster earnings report last week has fueled more bullishness on Wall Street, but can Nvidia, which is already up 60% year to date, continue to carry the market? What are some of the biggest risks in the market that investors need to watch out for? And can Nvidia, which already controls more than 95% of the market for specialist AI chips, continue to grow at this pace? Well, here to answer those questions and more is David Nelson, host of the Money Runner podcast and chief strategist at Belpointe Asset Management, which has over $3.8 billion of assets under management. David has over 3 decades of experience in finance, including senior roles at Morgan Stanley and Lehman Brothers. David, always good to see you. Great to have you back on Kitco.
Michelle, it's great to be here. Thanks so much for having me.
Always good to see you. And I was saying earlier, you and I would go way back to the beginnings of my career in financial broadcasting. But I want to start off with the last time that you were in Kitco, where we left off last time. And you were here about 8 months ago, and you correctly predicted that stocks had room to rally further. Now, many of the guests on this show and experts at large were calling for a correction, for a market sell-off towards the end of 2023 and beginning of 2024. But you came on in June and you said that we had at least another 6 to 8% left to climb in the year end, with the S&P 500 likely to see between 18 to 20% gains for 2023. And David, I always like to give credit where it's due. You were absolutely right. The S&P 500 gained around 24% in 2023. You said between 18 to 20% at least. So good call there. That rally is still not over. And that's what we want to ask you. How much room then is there left to run? What is your read on the market at large right now?
It's a nuanced answer. There's no hard target that I have for the S&P 500. I think maybe the disappointment so far this year, there's not many, but the one disappointment is that the market has not broadened out to take, some of these smaller market caps, mid caps and small caps have lagged. And when you dig down into the numbers, you can kind of see why is at the index level, mid caps, and maybe the equal weighted S&P 500, the fundamentals are just not there. The earnings growth is not there. There are dozens and dozens of companies out there that are fabulous and growing hand over fist, but at the index level, it's not there. The S&P 500 has largely been carried from an earnings perspective by some of the names that you just mentioned. Certainly, Nvidia is at the top of that list.
Right. And that's a concern, right? That it's not a broad-based rally, that it's mostly being carried by the Magnificent Seven. And we want to dig into the market at large, but let's focus specifically on that top, most magnificent stock, and that, of course, is Nvidia. Before we get to back to your larger macro outlook here, and a lot of sentiment about growth of AI clearly driving this, but the fundamentals, they're very solid as well. If you look at the latest earnings, adjusted earnings per share skyrocketing 486%. I mean, year over year, that's huge, to $5.16. So looking at the trend of AI and looking at the fundamentals, do you feel that this Nvidia hype is justified?
It is. And I would go to Mark Andreessen, who correctly predicted that, the rollout of AI is probably bigger than electricity. I would equate it back to when the electric grid rolled out. I think too many people make a mistake and compare it to, say, the dot-com era and some of the valuations back then. And Nvidia is nothing like that. A comparison of Nvidia to, say, Cisco back during dot-com, back then Cisco was trading at maybe 130, 140 times earnings. Nvidia is cheaper than Microsoft, growing at probably 4 or 5 times as fast as Microsoft. So I think the biggest mistake that's made about Nvidia, too many people think of it as just another chip company. This is a platform company with an entire ecosystem that goes along with it. These chipsets, they're 70 pounds. They are massive. They're almost like mainframes. And another company coming along with maybe just a slightly faster chip is not going to knock Nvidia off. So, yeah, I get the price momentum, and it's scary, and there'll probably be some kind of a pullback here, but that should be an opportunity for those who aren't in, should certainly get involved.
All right, so I get that you're saying the AI trend is not a trend. It's a phenomenon. It's here. It's like electricity. It's like the internet. Jamie Dimon has made, similar comments to that. But again, let's bring it back to why Nvidia is necessarily the best company to ride this. I mean, I know it's got its chips, the GPUs, graphic processor units, and they're accelerators initially designed for video games and mining and self-driving cars, crypto mining, that is, and training of AI models. But I mean, are these chips that much better than the competitors' chips?
They are. And it goes to the heart of the design, because along with it, it's not just the chipset and the silicon involved. It is the software that's there to manage that chip, the tools that are needed to manage this platform. It's very complex machinery. There'll be other players, and certainly from a perspective of over-earning, Nvidia is over-earning right now. And when you're this big and this powerful, and your margins are this large, people are going to want to intrude on that. But it's going to take some time for others to catch up. They'll all have a space for this. But if you exited Apple when it was $1 trillion because you were scared of just how big it was, you left $2 trillion on the table. And I would say the same is true about Nvidia. The price momentum is scary, and maybe you've missed it in the short run. But this is an important company that's going to be with us for some time.
So you're still suggesting that if people are not in Nvidia, they get in at what? I mean, it's what, $787 a share, I think, right now. You're still saying this is still a decent point to get in.
It's not a decent point. It would have been better, certainly, 3-4 months ago. But at some point, you're going to have to find a way to get in. So maybe for most people who aren't in, they're going to have to scale in. Maybe the biggest mistake that's been made in the last several months, and this was by some of the brightest minds on the planet. Everybody going into this number, the urge to take some of your money off the table and sell, say, half your Nvidia and lock in those profits. That was an emotional response, because I don't think the fundamentals justed that. Yes, the price had gone up dramatically, but it's an emotional response in the sense that you're locking in victory. And I get the urge to do that because it's the no-lose trade. If it goes up after you sell it, you're smart because you still own some. If it goes down, you're still smart because you sold some. But what are you going to replace it with? And you lose the compounding effect of the wealth that creates. As a 2% position in Nvidia, where I started more than a year ago, is now a 5% position. The money that we're making from it is that much more. At some point, I'll be forced to trim it back because it'll just be too large. But for right now, I'm sticking with what I have.
Right. And, you make an excellent point. You usually say, look, I've made this much money. I'm going to take some profit off the table. That's the prudent thing to do, but I'll still stay in the game. David, I made that move. So I can totally relate to that. But what point are you looking at that you're thinking you may need to trim some profits, but still maintain a position? I mean, as this grows, it becomes a larger and larger part of your portfolio percentage-wise, right? So is there a point or a share price where you're thinking it's time to cool off, or at the very least, take some money? Yeah,
if I look at right now, the fundamentals demand that I own it. All right. There may come a time, maybe it'll be 6 months from now, and the fundamentals won't look as good. Or maybe some of the risks that we talked about, maybe somebody else will have a better mousetrap, and I'll have to make that adjustment. at that point. Look, if you bought this stock and it's now 50% of your portfolio because you run a very concentrated portfolio, well, then you've got to take the money off. But right now, I'm only slightly above a market weight of the S&P 500. And frankly, if I sold it here and this continues to run, it's going to be hard for me to keep up. So I'll have to stay with the position until the fundamentals say that I'm not there. Not just the price, the fact that it's gone up a lot, but the fundamentals and the valuation.
Yeah, okay. And the fundamentals look very solid when you dig into the numbers. It's not just a sentiment play. You mentioned some of the competition. So who would you say is Nvidia's closest competition right now?
It's probably several. I mean, certainly AMD is going to be in there. But every one of their customers, from Microsoft to Alphabet to Amazon, all of them are trying to manufacture their own silicon, and in some ways, they will impede on some of that space that Nvidia enjoys right now. Certainly, Nvidia's got these massive margins, and massive margins always invite competition. But you're going to have to come up with a product that can compete with it. And right now, that isn't there. Doesn't mean it won't be there at some point, but at this point in time, that is just simply not there.
So if some of the customers of Nvidia are moving into creating their own chips, I mean, that obviously will hurt the fundamentals. But you're saying that's still a ways away.
I think it's certainly a ways away. Look, if I took the fundamentals, if I took a spreadsheet of Nvidia fundamentals and I put it in front of an analyst and I took away the name Nvidia and I took away a price chart showing how much it's run, it would be tough to find an analyst that would say that this is not a buy.
Okay. So Nvidia, still a strong conviction buy for you. You're definitely not trimming your position, and you're thinking if you're not in the Nvidia game, you should get some exposure to this. You mentioned, though, that you could see a slight pullback. I mean, would that be based on broader market concerns?
It could be both. There could be something out there that I haven't seen. It's certainly the market can always pull back at any time. It always bothers me when I don't see the market broaden out. You're even seeing the dispersion within the Magnificent Seven. They're not all winners anymore. You've got a little more than half are still doing well. You've got the laggards this year are Alphabet. For some obvious reasons. They need an Elon Musk moment at this point. They probably should purge about half their employees because they've corrupted the data and they've lost the confidence of the American public. Tesla is a fabulous company, but some people are starting to think maybe this is in fact a car company and not a software company. If it is a car company, then it probably should be valued with a lower multiple. And the final one is, of course, Apple, for some obvious reasons. They're in between product cycles. They just don't really have a new product to generate the interest. Hence, the sales have lagged, and the sales are still lagging at this point. They're being buffeted by the fact that it is Apple. It is a large ecosystem. It has a pretty large moat around their services platform, but they're kind of expensive at this price.
Right. So just for the clarity of our viewers, let's go back to the Alphabet comment that you made there. Of course, Alphabet, the parent company of Google, saying that they need a purge. I'm assuming you're referring to their AI Gemini, which has demonstrated tremendous wokeness, shall we say?
It is. It's almost frightening. It's something that many of us had suspected. They've always pushed a political narrative. And now it's become quite clear that their employees in the coding of their software have put in their own political biases. And I think what people want from these large language models, they want the truth. They don't want it colored. They just want the truth. And if people feel like they're going to Alphabet and they're not getting the truth, they're getting a political viewpoint, they're going to go somewhere else. And in fact, that's already starting to happen. I think you're going to see some major changes at Alphabet probably over the next year. This is not irreparable. This can certainly be fixed, but they're going to probably have to make some changes in management, and they're certainly going to have to make some changes in their employee base. And like I said, an Elon Musk moment is probably what it will take.
Right. And, of course, that bias is impacting the accuracy of results. When you ask an AI tool to, draw a photo of an astronaut, for example, and the whole group were like female African Americans. I'm not saying that you don't have female African American astronauts, but it's the wokeness of the AI is starting to impede on the accuracy. And that's just one example. Elon Musk was tweeting about this as well, that it's starting to not reflect the reality, and rather perhaps the bias that they hope would be, and that is detrimental if this is supposed to be a good source of real intelligence. Is this a concern to shareholders at large yet for Alphabet, do you think?
I would think. I can't imagine any shareholder that isn't upset right now. It's certainly lagging this year. It's attractive from a valuation standpoint. It still generates, a tremendous amount of income. So it's, certainly still a good business model. I think the other concern is also AI itself. It is disruptive to the current business model at Alphabet, which is, click search, which we're all used to. We go in there, we click on the blue link, and we keep searching until we find what we want. Every time you click, that's income and generates revenue for Alphabet. If you can just type in or talk into a large language model and get your answer right away, the revenue generation is maybe somewhat less. So people are trying to figure out how Alphabet will deal with that. This is an added problem that maybe a lot of us hadn't foreseen,
right,
that they're going to have to navigate. And it's very unfortunate, but it's clearly something they have to deal with, and that they should do it quickly.
All right, circling back to the Magnificent Seven, other than Nvidia, do you have another position there that you're saying you're sticking with?
You mean other stocks in the Magnificent Seven?
Yeah.
The only one I don't own at all right now is Tesla, and I'm a fan of the company. Apple is probably my smallest position. Apple is probably about 7% of the S&P 500. I think my current position is something like 1.9%. I've actually chosen with some of these very large companies as a portfolio manager. I'm not talking to you as a trader. As a portfolio manager, these large companies, I have found it is better to underweight them rather than not own them at all. Even Alphabet I own, but it's less than a 50% weight from what it was. After their last earnings call, I sold half the position because, frankly, it just wasn't good. And this was even before this bad news had come out.
Right. All right, let's get your take then, on the market at large. As we've said, Magnificent Seven really propping up the markets, but it's not really a broad-based rally so far. What are you expecting to see in terms of major headwinds that the markets can expect now?
Maybe the three biggest risks that I see and continue to be there are elevated rates, the higher for longer mantra from the Federal Reserve, which translates over to commercial real estate, which is really problematic. You've got 50% vacancy rates, even more in some of the commercial real estate, some of the marquee buildings out there, which translates over to the regional banking sector, which is, in my estimation, really at risk because a lot of this commercial real estate paper, the loans that back up this property, are held by these smaller regional banks. It's less so the JP Morgans of the world. I'm not worried about them. But those higher rates, they weigh on the economy, they weigh on the consumer. And it doesn't weigh on an Apple, it doesn't weigh on Microsoft, it doesn't weigh on Nvidia. But a lot of companies out there don't have the fortress-like balance sheets that these companies enjoy, or even a Berkshire Hathaway. They need those loans. They need that revenue so they can build out their business models and fund their inventories. But the cost of money right now is very high. Real rates are high. That's a drag on the economy. And the mantra from the Fed right now is this higher for longer. And I feel like they're not going to do something until the market bites them in the ass and forces them to act.
Right. And I'll circle back to Berkshire Hathaway and some interesting comments from Warren Buffett. But before we do that, let's focus on some interesting comments from Jamie Dimon, because he is also sharing your concern that commercial real estate could be a big problem here. He's saying if we don't have a recession, I think most people will be able to muddle through this, refinance, put more equity in. If rates go up and we have a recession, there will be real estate problems, and some banks will have a much bigger real estate problem than others. And he makes a statement, David, as he sold about $150 million worth of shares in JP Morgan. That's according to an SEC filing. What do you make of that?
It's on its own. I didn't make much of it, but Jamie Dimon's not alone. There are several, marquee, very wealthy people, the CEOs of major companies that have started to sell shares, and it's noticeable. And the last time I saw sales, even similar to this was in late 2021. I think many of them saw the handwriting on the wall. I think they have some concern, and they want to lock it in. It's not a profit until you take it. And
Right.
Jamie has been in there. I think he made that purchase. I think it goes all the way back to 2016.
According to this, it's the first time that Diamond sold shares since taking charge in 2005, since he took over
Wow.
JP Morgan.
Wow.
So,
okay. Wow. Wow.
That's a pretty big move if you put it in that context. Although he may need to, splurge on something in his personal life, we don't know.
Let's hope we see a yacht, the new Jamie Dimon yacht.
He needed an extra 150 million to, I don't know, appease the wife and family. Maybe it's not necessarily a reflection of the markets, but as you say, other leaders have been making similar moves. So let's bring it back to the rates and to inflation. We did see a slight uptick. I mean, there is some concern that maybe this Goldilocks scenario and the soft landing narrative may not really stick. Where are you on that?
Real rates are the Fed is restrictive. They'll tell you they're restrictive. They know they're restrictive. But we've now pushed the idea of a rate cut out. March and May are gone. Not happening. The market's priced that out. You got maybe a 50% probability in June, maybe a little bit higher for September. But from their talking right now, unless they get that 2% print, and I don't think we're going to get that, then they may just stay there and they may do nothing, and then it might take a market accident to force them to act, much like what happened almost a year ago today when we saw Silicon Valley and Signature Banks go under. In part, it was the restrictive rates, what it did to their held to maturity bond portfolios, but also the real estate, which is a big factor here. And I think Jamie Dimon is absolutely correct. It will be a concern.
So you're anticipating that unless we start to see another big crack in the system, Fed is holding steady at least until June?
That's what they're telling us. They've made it pretty clear. And I follow the Fed funds futures, which have been, they change on a daily basis. Look at, if we had a really negative jobs report, if like suddenly jobs went negative, they might change their tune, and you might see everything kind of shift around. I'm a little perplexed by the jobs numbers. They don't match up with what I see in the marketplace. They seem very robust when we get these prints, but when I without fail, almost every day I see another company laying off employees, especially in technology, especially at the high end. Engineers, coders, middle management are being purged at a lot of companies, and every now and then you'll get a print like UPS, which laid off 12,000 people in overnight.
So given those points, David, what does that mean again for your position in the markets at large? You said it was nuanced, but do you still see some upside if we're looking at the markets at large? Or this is what happens when you call things so correctly last time. I focus on getting a straight answer out of you. Or do you, think things stay neutral? Well, what's your read given all of these factors? And granted, a lot of unknown variables, but what's your call?
Market timing is probably cost people more money than anything. The lost opportunity of not being in the market, I find it's much better for me to reposition my portfolio to shift to what's working. When you have a $25 trillion economy, there's something out there working, and my job is to find that. I think the AI is, we think of it in terms of Silicon Valley, and we think of it, in terms of these fabulous technology companies and their business models. But the real beneficiaries are going to be the thousands of companies that use this technology. And we may already be seeing the productivity boost at some of these companies. And if you get higher productivity, you're willing to pay a higher multiple. So that's maybe the added tailwind. It doesn't negate some of the challenges that we just talked about. We live and breathe with a regional banking system. It's the heartbeat lifeblood of America. If something happens there, it's a problem. And, I'm very dependent on the Fed to make sure they don't make a mistake here.
Right. So are there any sectors that you feel comfortable avoiding, getting out of, or encouraging people to get out of without giving financial advice?
Right now, well, I shouldn't say that. I actually sold two of the best utility stocks I've ever had in my career today. So I have no exposure as of right now in utilities, not by design, because I'd like to get back in. And I haven't had any exposure to real estate in quite some time. I don't really have a catalyst to get into that sector right now. So right now, I'm not even looking there.
All right. So exposure to the markets in the sectors that you still think have room to run. And as you said, that's a lot of the AI play there. David, let's expand beyond. I mean, something that's also had a terrific run lately, Bitcoin. What are your thoughts there?
It's a tough one, and I've been on the other side of this trade, years ago. I think the fear of Bitcoin was less about the asset class itself and more about the fraud that went along with it. And obviously, there's been some pretty huge frauds in the last decade surrounding Bitcoin, but it wasn't really about the asset class. And like it or not, this is an asset class. So that debate is out the window. And
well, hang on, David. When you say frauds, you mean some of the dodgy characters? Is that what you mean by frauds? Elaborate on that.
Yeah, I mean, when you wake up in the morning, when you wake up in the morning, you found that your stash of Bitcoin has disappeared overnight because of some fraudulent venture. That's pretty scary stuff, and that doesn't necessarily happen. If you've got your gold in a safe at home, or you got your gold at the bank, or even have it in an ETF, that just doesn't happen. All right. But it's an emerging asset class, so maybe this kind of thing was supposed to happen. Now, with the advent of the ETFs that are out there, this has become an asset class and should represent maybe some small portion of your assets in a portfolio. We started out very, very small, in part because it only became available to us as portfolio managers only just very recently, and it had already made just a monster move. So we had to go in with a very, very small position, and we'll look to add to that. I can't imagine that it's going to get much more than 5%, and currently it's not even it's a fraction of that. And we'll use opportunities of a pullback to add more.
But big picture, you see Bitcoin breaking a new all-time high this year?
I'm not good enough to tell you that, Michelle. I'm really not. All it would take is a bad headline, and you could see it go south pretty quickly.
All right, but you're still exposed to Bitcoin, and you're looking at increasing your exposure to Bitcoin.
I think there's a whole legion of people out there that think of Bitcoin as a digital gold.
Right.
And those are people who want an alternative to fiat currency are going to look to gold and Bitcoin. And gold and Bitcoin fill both of those needs, and I own both.
So let's talk about gold, holding steadily above $2,000 an ounce, down about 1.6% year to date. This is after hitting new record highs at the start of December. What's your outlook on gold this year, David?
A lot depends on the Fed. I think it's holding up here because it's anticipating the Fed is going to cut rates. Mm-hmm. If the Fed doesn't cut rates, then maybe gold will drift lower, or even worse, if the Fed. There's been some talk that Fed might even hike rates. If that happened, gold would probably get hit pretty hard. But I think with the anticipation that Fed is going to cut rates, and I still think I've been wrong for almost a year now. I've had to keep pushing out my forecasts. But once they do that, I think that'll probably be a pretty good impetus to own more gold.
Right, and gold reacting to the Fed, gold also typically reacts to geopolitical developments, seeing as that it's known as a safe haven. And we've had a few geopolitical flashpoints already this year. I mean, we've still got, conflicts in the Middle East. It's on a maybe slightly lower boil at the moment, but we still have, conflict between Israel and Gaza that could expand. We still have Iranian proxies like the Houthis taking out cables in the Red Sea, creating chaos. We don't know how that expands, or potentially gets worse, of course, as the Russia-Ukraine conflict. We're hearing some word about a Russian space weapon that is designed to take out satellites that could cause tremendous chaos. There's so many variables here. How do you see the geopolitical landscape playing into this?
It's, what you laid out is pretty scary. I mean, every corner of the planet is a geopolitical hotspot. And those are the risks that we deal with in a modern society. And, certainly what's taking place in the Middle East, the economic implications, what's taking place in the Red Sea. We haven't even mentioned China, Taiwan,
Right.
What's taking place in Ukraine, Russia. It's all pretty frightening stuff. So I think what investors want, they want some kind of insurance policy. They want something in there that is not going to be correlated to all the other assets that they own. And certainly gold and Bitcoin fit that. Maybe the one or two things outside of maybe defense companies that are likely to go up on the day that everything else goes down.
Right. But so far, that sentiment of chaos hasn't really impacted the markets. Which is perhaps curious, perhaps not.
I think what's changed. I think that's part of a dynamic that's changed over the last decade, because I think investors have learned that every one of these geopolitical events, and every now and then we get one. It was in October we had the horrific attacks in Israel. Other times it's been terrorist attacks in some part of the world, terrorist attacks right here in this country, terrorist attacks in Europe. Every one of those times the markets go down, and each time that has been a buying opportunity, and that's ingrained in investors' mindset. So the dips have been less and less each time. It's probably going to take something pretty horrific to make a meaningful, hit in the marketplace, at least on a sustainable level.
All right. Certainly not rooting for anything horrific to take place. But another big variable here is, of course, the US presidential election. What are your thoughts there? When does that start to impact investor sentiment, if at all?
It's the prospect of chaos is pretty high. I don't know. I mean, this could end up being maybe the closest election of our lifetimes. I remember the last time I saw an election I thought that could be this close would be when we were counting Chads in Florida, with Gore and Bush. Yeah. And we didn't have a president for a number of months until close to the end of the year. And that was fairly chaotic. And we were in the middle of, the beginnings of a bear market back then. It'll certainly be disruptive. And the scary part about this election is no matter who wins, the other side is going to feel like they were cheated for whatever reason, whether it's electioneering, whether it's not the election process. Certainly there's some that believe the election process is flawed. I'm in that camp. There are others that may feel that if the Republicans win and if Trump wins, they're certainly not going to accept him as the president of the United States. They didn't accept him the first time. Yeah. How are they going to accept him this time? He's under indictment. They could try to end it right there. That will cause chaos. So the potential here for a very disruptive election to the markets is probably pretty high.
Yeah, so many variables there. We've had, unprecedented attacks against a political candidate, many calling it the weaponization of the justice system, again, depending on which side of the aisle you're on. On the flip side of that, we've got President Biden, but even amongst the Democratic camps, there's murmurs that he may not be the candidate, that there could be some kind of, switcheroo,
He still has time to back out. I think March 31st is what some political operatives believe is the drop dead date. I'll have to check my history on this, Michelle, but I think it was somewhere in here between now and March 31st is when Lyndon Johnson chose not to run. So I'm not quite sure of that, but it's quite possible he could back off and maybe let the convention decide, hand the baton to Kamala Harris. I think if that happened, a lot of other people would very, very quickly ramp up. Many are defending the president right now. guys like Gavin Newsom, who's probably a natural candidate. But you can bet he's got a formidable machine ready to go at a moment's notice if, in fact, the president decides not to run.
Right. Again, speculation, and I know I'm just asking you to guess here, but if we did get notification that Biden is not going to be the candidate, and then you say, the field opens up to other potential candidates that are geared up and ready to go, what kind of market reaction do you think that would bring?
Wow, I don't know. That's a great question. I'm not quite certain what that would mean. I really don't know if the markets would open up or down the next day if it happened tonight. It would certainly be disruptive, but it hasn't been out of the realm of possibility. So I don't think anybody's going to be terribly surprised. Maybe there'd be no reaction at all.
I guess expect the unexpected is the theme for 2024, right?
I think that's a great call.
Yeah, and everything can happen in 2024. So as we wrap up here, David, final thoughts, your highest point of conviction going forward?
I take these things one stock at a time. And I'll give you one stock here that I recently bought, very, very small company. And maybe it's a winner because I mentioned it. I was on the phone talking to an analyst about it with an Uber driver, soliciting. And before I got out of the car, he wanted to know more about the company. So maybe that was a good call. It's a very small company called Vertiv Holdings. And we talked about Nvidia before. And the chipsets, they get very, very hot. They require cooling. This is a company that just makes the air conditioning and that butts right up against the chip to keep these things cool. Size it accordingly. It's a very volatile company. Right now, it's the smallest position I have.
What's the ticker on that company?
The ticker on this company is VRT, Victor Romeo Tango.
Right. And you're saying that it's part of the AI chip infrastructure play,
it's an infrastructure
the ecosystem.
Play.
Yeah.
It's in the ecosystem, correct.
All right. Okay, David, we'll see how that one performs. Thank you, as always, for sharing your thoughts with us. Always great to chat with you, David Nelson. Appreciate it.
Thank you, Michelle. Thanks for having me.
All right. And thank you, as always, for watching. From me, Michelle Makori, and the rest of the Kitco team. We'll see you next time.